what I've got is it's like a live case study, I guess, of Australian dollar CHF. There's red folder news, I think, at 8:30 p.m. New York time, so quite a lot later. And that's red folder for Australian dollar. And it's a pretty complicated case study, honestly. There's a lot going on. So I've just got a few notes and stuff like on the TradeView graph to hopefully make sure I don't miss anything off. But fairly simple monthly fair value gap, and that would signal just to sting into that. The 2CR so far sting in. Pretty high close here. It's easy to sweep, so we swept that and continuing. So on the monthly, it looks like it's going to be a quite nice 2CR there, but there's quite a long time to go until this monthly candle is done. So monthly pointing us downwards, really. Yeah, and here's where the graph starts to get more complicated. So to get more precise, where did we reject off in the monthly? We came off this weekly order block / mitigation block, and you can see pretty nice sting into there and nice respect off it. So I'll just delete that now. However, coming into it, we have made this fair value gap or breakaway gap, whatever you want to consider it as, because it doesn't matter, because it is also an overlapping gap with this mitigation block or order block, whatever you want to call it. And so that area is going to act as fairly strong resistance as its overlapping defense. So we come down into it, and this candle, you get the initial sting into it, and you get quite a big rejection, honestly. So when you get this big rejection on this candle, for this 2CR to follow through, because you've now got this weekly overlapping a monthly fair value gap versus this weekly overlapping defense, you always take into account the most recent 2CR, which is off this defense. So for this to continue and to not fail, you would want to see this high getting taken and this low being respected. But also another thing to note, which gives us some extra confluence here, if this 2CR off this was going to be even stronger and the rejection off here was going to be weaker, ideally we wouldn't have had this candle, which with that wick fails to make this fair value gap, because we could have had still, even with the rejection off the overlapping BISI, we could have still had a fair value gap, something like that, or possibly it might have been a smaller one. But either way, we could have still made a fair value gap here. But I've written here, we closed through the potential new weekly SIBI off the rejection of the weekly BISI. And because we have done that, the 2CR is sort of working in both directions, because if this one is going to hold up, you want respect of this low and take this high. But in between that, you also have close through or don't close through this potential fair value gap, which would start there. And closing through obviously makes this side of the market's arguments a little bit stronger. Now, it has not gone on to fully disrespect this 2CR, and it's not traded towards this high. Instead, this high has been respected, but at the same time, this low is also still being respected, as we have not traded to that. I think it's also worth taking into account that the higher time frame argument of the monthly is a bearish one. So I think you're still stronger, the bearish side is still stronger than the bullish side when we take that into account, especially because this was quite a nice rejection. And then we head to the daily now, and it will get a bit more complicated, adding up the arguments. I will just remove these for the time being. So that's that weekly overlapping, and that's the rejection off that overlapping bit. So here we have a daily fair value gap, and it is a pretty nice fair value gap off of that rejection and off of this rejection. What I have written here is changing boundary, not the most supportive of the trap trader analogy. And what that means is, when we trade into this fair value gap with this candle, we've wicked it here, that is now the boundary, not the fair value gap, right? So anything that's coming back here, this is kind of irrelevant now. You're now looking, okay, can we sweep this to go lower? Or, oh, okay, can we disrespect this to go higher? So what we've got, decent rejection, but not a conclusive rejection, in my opinion. And then this second candle sweeps it and then drops lower, which is reasonably suggestive that you'll go lower down. However, it has also swept this side of the candle, so this is where it gets complicated, because there's lots of sweeps and sweeps and sweeps and new PD arrays that you're looking at. But that would have been the most recent one. So you swept this, and then you swept this, but it's still a down candle, so that looks like a decent rejection. But then, yet again, we come back up and we sweep. Now, the new boundary would be this. And we sweep that, and then we continue lower. But why that doesn't sort of agree with the trap trader analogy, because if you have people going who see this and they're going, I always do tend to get a bit confused with this, so I might have to just slow down with my words. If they're going long, something like this, with a short like that, and then they're longing to, who knows what support and resistance and supply and demand traders are longing to, or whatever. I don't know. But, they've set up whatever target they have. If you're going to keep on coming back to the boundary, you keep on giving these people who have gone long a chance to mitigate their position, right? If the market's gonna go lower, it should suffocate them in their stop loss. It should not come back to break even and let them mitigate their position. But here you can see we trade into it, okay, we come back once and then we come back again. So because of that, that is also not the most supportive argument for bearish prices. However, we do get some fairly heavy downward bodied candles next. So despite that, we're still looking like we might head downwards. and ultimately towards this daily, what would be the daily context down here, and then I've got some more. The next target would just be this resistance mitigation block further down, but ultimately we're heading to there. So with that being said, I'd say we're still a bit more bearish before, because the higher time frame, the monthly versus the weekly bullish arguments, we're still a bit more bearish, and here we're still bearish, but it could have been a bit better. So now we hop onto the 4 hour. And now on the 4 hour, we created this fair value gap. Again, a fairly nice one, although a bit of an up body candle, but still quite nice. We got this really nice rejection off it, actually, and this could have been potentially a nice entry, or an entry that you have reasonable grounds to assume we're still going lower. With that being said, we have known about the shaky arguments. Now, I wasn't awake at this time, I never would be. This is like I think it's like 2 a.m. for me. This 4 hour candle forms. So had been awake, and maybe you had weighed it up and gone short something like this with say that's 1 to 2, something like that. That could have possibly been an entry. But now what I am waiting for, essentially, is if this 2CR off of this fair value gap is going to follow through, then this is going to be respected, and in an ideal world, this is going to be this low of this 4 hour candle. In an ideal world, would be ran, not swept, right? It would be ran, and then with it being ran, we'd have the potential to create some sort of new fair value gap if it closed like that. But I think we've got an hour left. Yeah, we've got an hour left to this candle, and it now looks like, yet again, we've got a sweep kind of both sides of the PD arrays, of both sides of the market. Now, in that hour, this could change, or I won't close my mind off to say, yeah, we've swept it. But again, it's another time frame where we're kind of shaky. We're still a bit more bearish, because all the arguments are still adding up as bearish. There is no conclusive hammer blow, or we've traded back through something, right? But yeah, it's not looking amazing, despite the fact that if you were to not take into account these smaller details, this could have looked like a bit of a better trade than it was. And I'm not saying it might not come in, because honestly, if we still manage to close like a decent amount below there, maybe I'd be happy to enter, because this is a no resistance area. But at the moment, it's not looking amazing, just because of that sweep. And that, I think, is basically the case study. Now, I think one last thing you could take into account, institutional market structure, because you do also have this fair value gap that you've stung into, and this one. So this is 4 hour. This would be a 4 hour intermediate term high, and you could class this as the 4 hour intermediate term low, technically, but I'd say this one is the real one. It's the outsider on the graph. So I mean, I personally wouldn't use the market structure here. Some people like it, and I do like it, but just not really for this situation. I don't think it tells us much. I think it's more on the candles and the PD arrays that I've discussed. But yeah, that is the case study, and it was just a quite nice graph, although a bit complicated adding things up and looking at things. It's just quite nice in terms of highlighting why you should pay attention to detail, because possibly it could save you a loss. I can't really comment because I would not have been awake for this, but maybe in some world someone was looking at that and they took it, and they didn't read into as many details. But it still could come through, because I still think we are overall bearish, but it might be a consolidating trade that you're holding for a bit longer, and might not be a trade that you particularly want to be holding for so much time. And yeah, that's it. That is everything, hopefully.